Hey there. Today, I wanted to go over the top 10 or 10 features, things you should know when you're getting a mortgage, going through the loan application process. What are 10 areas that you can focus on, questions you might want to ask, details to figure out? And this is kind of my starting place. I don't want to overload somebody with too much information on a phone call. So, this video is meant to be a resource on kind of a general overlay of the mortgage process. If we're getting into a loan together, what to expect. If you have any questions to dive deeper on these topics, let us know. This is going to be kind of a quick overview. Oh, it'll probably be detailed and quick. So, we'll see what we get out of this. But I've got my list of 10 here, which is going to be how to opt out of credit solicitation so you don't get blown up by a bunch of creditors calling asking if you need credit for something,
Key point.
some details on your loan application points, information on what makes up your mortgage payment in general. We're going to touch on closing costs and prepaids, your escrow account, what's that's all about, appraisal versus inspection. We're going to go into loan documentation that an underwriter might request to actually get your loan finished, signing loan disclosures, which happens in multiple steps, closing, with your actual closing appointment where you close the loan and sign your final documents, and then how to get your first payment set up and managing your mortgage after closing, and whether you can contact your mortgage loan officer after the fact and some of those details. So, Bill, do you want to kick us off with some of the credit opt-out and what happens when you get a credit report pulled with a mortgage provider?
Well, the key with a credit is to get a mortgage, they require a 3-file merge full credit report. And when they do that, there's a thing called trigger leads that get triggered if you don't opt out, that once you pull a credit report, the credit bureau sells this list. Then the next day you get hounded by 65 vendors knowing you just applied for a mortgage. So when you opt out, it stops that from happening. Now, Congress has just passed, and the president will sign this legislation to eliminate trigger leads, but that probably won't go into effect for 6 months. So you want to do this now. It takes about a week to go into effect to protect you from that process. You can do a soft pull credit report, which we oftentimes do with a pre-qual, but when you have to get right down to it, you got to do a full-blown 3-file merge at some
And
point
that's
during the
TransUnion,
process.
Equifax, and Experian. Those are the three bureaus that we pull credit from.
Yep.
And that can cause all of this mayhem for your phone to start blowing up with all sorts of stuff.
Yeah, you don't want to experience that situation, and we don't want you to do it because you think we did it.
Right.
It's not us. It's the credit bureaus that sell the list. They charge you enough for a credit report, then they make money on the side. So all this will go away. It'll be a breath of fresh air, believe me, for all lenders.
And there's no cost to opt out. You want to opt out before you get your credit pulled. And then when it comes to getting your credit pulled, you can get your credit pulled by a couple different lenders within a 30-day window, and it won't hit your credit score the same as if you're getting it pulled all the time. So there's certain rules set up for credit reporting that allow the consumer to go mortgage shopping, but you still want to opt out before you do that so that as you shop with a couple different lenders, because imagine you made 3 mortgage applications, 3 credit pulls, and you got all of these trigger leads calling you, it would be a nightmare.
Yeah.
I mean, we've had people get over 60 phone calls in a single day
The following day
within a couple hours.
on your cell phone, which you didn't have on your application.
So that's something to do, no cost. Any lender can do that for you regardless of who you work with. And then when it gets to actually pull your credit, that's when you pay your upfront fee, usually for your credit report. Some lenders charge upfront fees, some don't. Some fees can be as low as like $85 to $100. Some can be like $250 for your credit report.
Yeah.
So that's another key piece of getting into your mortgage application. How much are you paying for your credit report? And that's another reason why I think it's good to get to know your mortgage loan officer. Because if you spend $100 to pull your credit report and then you don't even like that person, well, okay, so there's some mental math that goes into that equation, right? Like if I'm going to spend money, I want to make sure that this is a person I can work with.
Yeah, I think it used to be that lenders would not charge you up front. I think those things at times have changed. And that's another big difference between wholesale and retail is we have access to the better pricing across the country. And that makes a huge difference. And unless you talk to your lender and go through the costs, you don't know that because you may think the average price is $250. It's not, but a lot of lenders charge that today.
So going from credit report, which is our first piece of the loan application, we can go into some of the details of the actual loan application process because I think there's a few details that I wouldn't assume that my loan officer needs right up front. So, of course, they need to know your income. Your credit report shows how much debt you have in your monthly bills, but also like your employer's phone number, HR contact information, so that when you go through with the loan, they can do your work verifications. Are there any details you can think of on the loan application that don't stand out as being obvious?
I think the biggest issue is most loan apps now are done electronically. So the computers don't necessarily ask you for all the specifics, and you're not there talking to your loan officer like you used to be. You sat down in front of them and did your loan app. But typically, your work phone number, that's a huge one, just so they have that. But they do have that other thing we have to do when your loan closes, a verbal verification of employment. Need to contact an HR or a manager or somebody they can reach. It's just a verbal to get done, but they need that to fund your loan. So little details like that, you need to make sure you fill it on your application. And, the other key thing is it asks for 2 years of work history and 2 years of residential addresses. So don't put down a year and a half. We need all 2 years, even if you lived at home or in college or whatever. You just need to put it in there. We got to have it covered 2 years in both. Even if there's gaps in employment, we got to go back 2 years for a work history.
And so if someone leaves this information off of their application, we'll call them and say, hey, we're missing this and this and this. Can you fill in some details here? What's your HR phone number? What's your address from a year and a half ago? And we'll put those things in there. So it's not a pass or fail. You can leave it blank if you have questions or don't know it, but those are the things that we will need to get to have a completed loan application along with your credit report. So those will be all the things we'll take in. And then we'll talk about loan documentation a little bit later, but a complete loan application would include bank statements, pay stubs, tax returns, a myriad of, well, maybe not a myriad, but some key documents for us to actually verify that the information on the application is accurate and that we can go ahead and approve that loan.
That's why it's key to kind of have a discussion with your lender before you do the loan app or while you're doing your loan app. Check with them, because if you're self-employed, it's a whole different ballgame of documentation. If you have 16 investment accounts, you may not need to put them all on there if it's not necessary for the purchase of the loan or the refinance. So sometimes you might have, a lot less data to include. You have that discussion first, because always add stuff to it.
Or you might have a lot, like in the case of, we have some clients with a vast amount of rental properties, and you got to put all those on your application. So if you have a real estate empire and you're building it, then your application might become a lot more cumbersome.
It is. Everybody's different, and like you said, you can have a lot of assets, and believe me, I've seen variations that.
Or you have 75 grand sitting in your savings account. You work a salary job with no debt, and your loan application is a piece of cake.
Yeah.
Those, we love them, and those are great borrowers, and people that have financial minimalists, that's a dream and kind of not the norm in our current society. But there's a range of applications, and your needs might be on the minimal side or the complex side. That's why it helps to have advice from people who have seen the whole gamut.
Yeah, there's no incorrect way to fill it out, because we can help augment that during the process. But it's have all the data handy when you start, and ask questions. If you say, well, hey, do I need this? Probably do. And if we don't need it, we can shred it and get rid of it. So some documentation you may not need, but most times you typically probably will need it in a situation.
Yeah,
but,
you're probably going to need more rather than less.
Yeah,
in most cases.
It all depends. There's very different levels of documentation on loan products, but in most cases, the main criteria is the same.
So that kind of brings us into the next detail, which is your mortgage payment. Now, a lot of times it's just, and even in the beginning of my career, I used to forget to calculate the mortgage insurance. So you've got principal, interest, taxes, property taxes, home insurance, and mortgage insurance if you put less than 20% down. And you could potentially have an HOA.
Right. It's not in your mortgage payment, but it is in your qualification number.
And I would call that part of your housing expense would be your HOA payment. And your HOA payment could change, your property taxes can change down the road, and your home insurance can change down the road. So even if you get a fixed rate mortgage, your housing payment can still change, even if your mortgage payment is not changing. So that's where it's really confusing when your mortgage is escrowed, or when impounds are included in your mortgage, so your taxes and insurance are included. It feels like your mortgage payment is changing, even though your mortgage payment is not. Your housing expenses can fluctuate. And actually, often we see that your property taxes will go up over time. And so your housing expense will increase over time, even when you buy a house.
Yeah, because if you decide to include them, then the lender determines how much they're going to collect for your taxes and insurance based on when they change and how much they change. And they always have a cushion in there because they don't want to be short. And those things adjust, and it makes a difference. Depends on what state you live in and all those details too. You
And
do,
well, I was sorry to jump in here, but part of the reason that they have those built in, your home insurance is due once a year and your property taxes are due twice a year. And those are sizable chunks, right? So 6 months of taxes could be, it could be $3,000.
yeah.
And then your home insurance could be $2,000. And so if you're paying those monthly, it's a lot more manageable than paying those lump sums at odd intervals throughout the year. So lenders put this in a long time ago to include their escrow accounts to kind of make the loan less risky. And the escrow account is at no expense to the consumer. So you just pay in monthly on your monthly mortgage payment. A portion of taxes and insurance goes into your escrow account and just waits until those payments are due, and then that gets siphoned out. So it's actually pretty cool.
Yeah, and there's always a surplus in there, so they have a cushion, which belongs to you if and when you sell your house. That gets refunded at that time. But they always want a cushion for the fluctuations. And we never really see taxes and insurance go down. They tend to go up. And so that's why it's out there. But you do have the option, if you put 20% down, to include them in your payment or pay them on your own. And it's split down the middle, what people like to do. So it all depends on the consumer and what they like to do. And then if it's your first time, we recommend including them so there's no surprises to you in the process.
And then one last thing I'll say about the monthly mortgage payment, when you're shopping different lenders or who you want to work with, not only can different lenders offer different interest rates, right? So the market fluctuates, interest rates change daily. Mortgage insurance also has a rate, and your mortgage insurance rate can fluctuate between lenders. It depends on your credit score, and that's a huge detail. I've even seen my mortgage insurance be half of another lender's mortgage insurance, like from $95 a month to $50 a month.
That's because you have access to different lenders that have specialized pricing.
And that particular $50 a month variable was on a $250K loan amount. So imagine the variable on a, $500,000, $750K loan. So these bigger loan amounts, you're more sensitive. King County, Thurston County, average price range is pretty much $500 and up.
That's why fees, the cost to get your house is important as the price.
Yes. So that's kind of the small information we'll touch on payments. And that kind of brings me into your closing costs and prepaids. So when you're thinking about your monthly mortgage payment, don't forget that you might have mortgage insurance on there, and then that can fluctuate between lenders. And then when it comes to your actual cash to close, you've got your down payment, your closing costs, and prepaids, because they want to collect an upfront cushion for homeowners insurance and property taxes. So there's a lot that goes into that cash to close figure. It's not just down payment and monthly payment.
Right, and prepaids are known as reserves or impounds. They have several different names, but basically it's your taxes and insurance and then the prorated interest at the time you close.
And then as far as closing costs, you have normal closing costs to get your loan closed, which we won't go into, but there's just normal costs involved, and you have title and escrow fees and all these things. But then you have interest rate fees. So you can pay a higher fee to get a better interest rate, but then you have more closing costs if you do that. So
you can have discount points.
Right. So you can increase your closing costs to get a better interest rate, or you can reduce your closing costs to get a worse interest rate. So there's a sliding scale there. And that's a strategy point to talk about what's your cash to close comfort zone, what's your monthly payment comfort zone, and how can you structure this to really fit your scenario. Do you want to do a big down payment, small monthly? Do you have, you're going to use all the money you have on your down payment, so you take what you get on the monthly? What scenario do you want to set yourself up for?
Yeah, it's another strategy point to review all that detail with your lender to first make sure you're qualified, and then you have the options to say what fits.
Right.
How much do I want to put down, and do I want to have a cushion on the side to handle any things after the fact? Because believe me, being a homeowner, things come up after the fact, no matter what.
Yeah, the year is 2022, and you buy a house that was built in 2010. And a year after buying your house, your fridge, original 2010 fridge, starts groaning, sounding like a ghost lives in there. So all sorts of things can happen. A new fridge these days is $2,000. So there's lots of stuff to budget down the road. So making sure everything up front fits is obviously a huge key detail. And then that would kind of take us right into our escrow, which is our fifth topic here. Touched on this earlier with the escrow account, but your loan is going to close through a title company. and that is going to have an escrow officer and a title closer that manage that account and manage your closing. So this is a third party. You've got your mortgage person, you've got your real estate agent, you've got your seller. All of this is getting routed through the title company as like the neutral third party. They're going to hold an earnest money deposit, which is like a good faith deposit. And escrow is basically kind of the hub of neutrality for the whole transactions. What do you have to say about escrow that you think might be relevant for people getting into their first program here?
Yeah, key thing is you're referring to here on the West Coast, because you go East Coast, you have attorneys to handle your escrow accounts and your closings, which usually typically are an additional higher expense. But escrow, it's nice to have a local company, obviously, you're dealing with. This day and age, they can do them electronically. They can do it virtually. But let's go with the standard escrow fee where you show up at the title company and you sign your closing docs. Typically, we love to show up there to make sure there's no last-minute surprises, and we answer your questions. And sometimes the agents are there, sometimes not. But the escrow officer will be, and they go through all the documents sent by your lender to sign all that information and to make sure they've satisfied all the details of your purchase and sale agreement so then they can fund your loan.
So, and you'll have several loan disclosures that you sign when you start your loan, and then about halfway through your loan, and then right before closing, then at closing. So you'll see all of your loan information several times. And when you get to the closing table, the title person will walk you through these documents one more time. If you have a good loan officer, they've probably talked you through these disclosures at least twice already.
Yeah.
And maybe you don't have questions. Some people just sign and they're done. And other people have tons of questions. And we're here for both. We love it if you trust us, and we'll blow through it as fast as you want to. And other people, if you want to sit down and take your time and ask the questions, that's really what we're here for. If you have no questions and you just want to run through it quick, then it's like a streamlined process for us. But where we can provide more value is in taking the time and going, getting to the comfort zone where you actually know what you're doing, instead of just, oh, I'm going to buy this house. I hope it works out. And I'm not, I don't know. I think there's a sense of comfort once you really take the time with the decision before just jumping into it.
Well, if you don't have any questions, we're going to ask you some questions.
That's right.
Because there's no dumb question when it comes to buying a house or closing on it. And when you get to the closing table, you get to see your note, which is the terms you're agreeing to, and your deed of trust, which is the legal document that gets recorded that securitizes your property. Those things are key, and those, they're long, and but it basically spells out some details that we would love to review with you, and the escrow person will too. Also reviews, your final title policy that shows that everything's, cleared off the title so you can transfer this property. Those are key ingredients to make everything work out. And then after you do all that, then your lender has to send the money that you've been approved for to the escrow company so everything can fund and everybody gets paid. The seller gets paid, the agents get paid, and everybody's happy. So all those things have to take place. That's why the escrow company is really important, because they coordinate all that. You wonder, why am I paying this fee? Well, that's why, because they do all that work. And you don't see it, but it happens, and it's a lot of work.
So escrow will help get your transaction started, up and running. So it's credit pull and loan application. Go make an offer, get your offer accepted, get the file set up with escrow. You've talked about all your cash to close, your prepaids, closing costs, monthly payment, and now it's time to actually order the appraisal or the home inspection. Now you might order a home inspection first to make sure there's nothing majorly wrong with the property, and then you order the home appraisal. Right, home inspection is for you, the buyer, for your protection. Is going to be around $400 or $500. Appraisal is for the lender, so that we know the value of the property that we're going to issue the loan on, and that's going to be $800 to $1,000 for the appraisal. And that's you're going to pay for your credit report, then you're going to pay for your appraisal. The home inspection is not required, but it's a good part of due diligence for a buyer to say, hey, I'm going to do an inspection. We're going to check out everything. And then when we order the appraisal, we already know it's going to be there, and that's going to give us the actual value.
Yeah, the difference between an inspection and appraisal is significant. And an inspection is a licensed inspector that goes through and looks at every nook and cranny, and I mean that, from the crawl space to the attic, everywhere, and puts a condition factor on everything in there. So you're aware in the future stuff you're going to have to contend with or that you want to get resolved before you close. An appraiser They go out there and their job is to justify the purchase price based on their market criteria. They look for safety and health issues, deck railings, all the windows open, all the toilets flush, everything heats, all that stuff that has to be, functional. They're not looking for all the specifics that an inspector does. The inspection is for your eyes and your agent's eyes. All we're going to find out about it if you accepted it, cleared it, and if there's any negotiations that take place after. We don't see the inspection. That's for your review. The appraisal is our review, and that's where the underwriters look at those details to make sure everything fits for the loan that we're putting together.
And if the appraisal comes back and says, hey, there's a hole in the roof, you're going to have to fix that before closing, then there's other issues. So if you're going into a property that needs work and you know it needs work, you might get the inspection first and say, okay, how much work do we really need to do, so we can kind of plot the numbers out before even getting the appraisal ordered. And then obviously the appraisal has to happen fairly quickly so that you can get your loan closed on time. So that's another part that you have to juggle. Normally you get your contract accepted, get everything set up at escrow in a day or two, and then you order your appraisal. So normally that's happening within the first week, but depending on the property, if it's a real piece of work that needs help, maybe you go to a 60-day close and you have some extra time to run these numbers. But normally we're doing it in 30 days and appraisals come back pretty quick. But there's a big difference between that inspection and the appraisal. Not everybody's getting an inspection, even though you probably should always get one.
I'd say most people do. And the thing is in a 30-day transaction, you don't want to wait 3 weeks for the appraisal.
Right.
You want to know if there's going to be some time, then you're going to be looking at an extension on your purchase agreement. And you want to make sure we know that up front, because we lock in for 30 days, which is very important what your pricing is these days. Kind of have that, in the background. If you know up front there's issues with the property, we're going to look at a longer term lock if something has to be resolved. If those work orders can be taken care of before closing, or not. And that's another key factor.
Yeah, and I guess we can touch on this briefly as your interest rate lock. So you pay more money the longer you need to tie the money up for. So if it's going to take you 25 days to close the loan, you're going to get 30-day lock. So you've got 30 days to get that loan closed and delivered to the investor. And that's pretty standard. And so that's what we talk about with interest rate lock and time frame. If it takes you 31 days and you only secured that money for 30 days, then you miss out and you've got to revert back to market rate, which could be better or worse. So the timing is very important because there's a cost of money, right? Time is money, money costs time. Pretty much it on interest rate lock, but it is important to manage your time frames when getting into these scenarios, and that's pretty easy to manage. You talk about it up front, and it's easy to tell if a property needs work or not just by looking at the listing. So
yeah, you have a pretty good idea when you're making your offer. And the other thing to go into about locks, which you can discuss with us or your lender, is there's options for extensions or float downs, all kinds of details. Every lender is different. There's no standardized feature there other than, the extensions will cost more money. Some give you a break, some don't. Everything varies. That's why we love having flexibility of dealing with multiple lenders.
Now, speaking of multiple lenders, there's a lot of options for different lenders, different loan programs, but there are some basics when it comes to loan documentation. So for most people, it's going to be a standard package: pay stubs, bank statements, credit report, tax returns. Anything else you can think of that's in the standard loan documentation category?
Copy your driver's license. They have to verify your ID today. Yeah.
Okay. So pretty simplified. Where it can get complicated is if you provide a bank statement that has a large deposit, we need to go see where the large deposit came from. Okay, so if that came from your investment account into your savings account, now we need 2 months history on your investment account. And if that has a large deposit from some other savings account or a checking account, we need to paper trail your source of funds for this transaction with a clean 2-month history. So any large deposit, we might have to paper trail and chase that. Certain work verifications can be difficult, it seems like. If it's not easy to get a hold of your HR person, those can cause slowdowns at the end of the file. Making sure you provide all pages of your bank statement. If your bank statement is pages 1, 2, 3, 4, 5, and page 5 is left intentionally blank, we still need page 5. So those are some of the small things. Anything else comes to your mind on loan documentation that stands out? That's probably the easiest part of our job.
Yeah, typically like you said, all pages of a bank statement, large deposits. If you held your money sitting in a cookie jar and you just threw it in the bank, that's a challenge. But there are gift funds. If mom and dad gave you money, then mom and dad can write a gift letter. There's documentation to support that and that type of thing. So there's all kinds of things, but you really want to, before you receive any money or transfer money, talk to your lender so you know how to document it so it's not painful, because you're going to think we work for the FBI by the time we get done going through some of these things, because that was one of the key things after 2008 is where'd this money come from?
I think the other thing would be a letter of explanation. So if you have an address on your credit report that is not on your loan application within the past 2 years, we would have to explain, hey, where's this address? And you say, oh, I lived with my friend for 6 months and I put their address for mailing, or whatever the explanation is, to show that you have no ownership in that property. So there can be letters of explanation that come up that can help you identify certain inconsistencies or things that are coming up on the loan application.
Yeah, residential history and work history, make sure you have 2 complete years. And if you paid rent, or even if you didn't, where did you live? And specify if you did. Maybe it's with family, so you had to pay with indentured service.
And if school is part of your past 2-year history, we need to know what you've been doing for the past 2 years. So if part of that was 6 months unemployment or 6 months school or whatever, you've only been working for 6 months, and so the past 2 years includes a year and a half of school. Those are certain things that we can deal with. It doesn't mean that you have been working for 2 years straight on your current job. We just need 2 years of history of what employment have you had for the past 2 years, whether you've had any or not.
And key ingredient on that is if you got a job in a career of what you studied in college, your college time education counts as work history. So all that will compile into that 2-year period of time.
But that's the fairly straightforward part, is the loan documentation. A part that might be less straightforward as far as ability to understand it is the loan disclosures. So when you accept a loan or a loan interest rate, you say, hey, that sounds good, let's move forward. We're going to lock your interest rate, and we're going to send you a bunch of disclosures to sign that say, hey, here's the terms that we've actually secured. They're locked in, and these cannot change. Certain fees cannot change. Interest rate cannot change. Here you go. Read these over, sign them, and then that's your commitment, right? So there's a lot to sign. It's all electronic. I guess we can print some and do them ink signed, wet signature, but that's pretty uncommon these days.
Well, I know some people that happen to do it on every file, but yeah, it can be done either way because it's all within your comfort zone. Ease is electronic. That's great because it makes it so much simpler. But if you want to sit down and you can, and we can still go through them, the details, of what you're signing, on the phone while you're signing them. So all that stuff exists, but we want you to feel comfortable, and it's challenging because it's a lot of stuff, and some of it's redundant. You might have 2 or 3 forms that say the same thing, but it's all designed to protect you as the consumer, and we have to be transparent because we want to make sure you're aware of everything. And it gets back down to all the fee breakdown. All those things are really important. And we get quotes from our local title and escrow company, so ours are accurate. It's key. Sometimes people just put generic numbers in there to do disclosures. We want to make sure you know what the bottom line is.
Yeah, your loan figures can improve, but they cannot get worse in many cases. So some lenders will over-disclose and say, hey, your cash to close is 20 grand, when really it's only 15 grand. And obviously that's a super low number. I'm just using this for a bad example. Say they overinflate their cash to close number so that they can get their disclosures out, and then your real number is actually less. Well, that's one strategy if you're working crazy fast. I always think in my work history, I've always tried to get that number as close as possible so that a customer knows what you're actually getting. And I might overdo it a little bit just so that if there's any change, it's a change in the right direction.
Right, because if you underdisclose, we're liable for the difference.
Right, we'll pay the difference.
We want to be accurate. And, it makes me jump into a point where you're comparing lenders. A lender can give you a quote, and the only thing the main thing is look at the principal and interest number. Because they can, if the taxes are actually $500, but they say, they're only $420, their payment looks better, but it's not accurate. So all you can do in some scenarios is compare the principal and interest rate and fee because some lenders undercut that on quotes to say, hey, yeah, it's only going to cost you this much. Well, it's going to cost.
Yeah, so your taxes and insurance, they might fluff those numbers, but your mortgage insurance is another one you really should be looking at because, like, I'll keep talking about the scenario I had. I had not only a better interest rate, but a much better mortgage insurance.
Yeah.
The difference of my mortgage insurance was bigger than my difference in the actual interest rate.
That's why everybody's not the same.
But the cumulative effect for the customer was a no question, no brainer. Like, oh yeah, well this is better. Let's go for it.
Yeah, and
on that one, the home inspection came back before we did the appraisal, and they needed a new roof, and they're like, oh, we don't want to go forward with this.
Yeah.
So that everything we're talking about here actually kind of applied on that one particular transaction. You know, it's kind of unusual now that I think back on that.
But it's true. I mean, the whole purchase process, there's so many variables, and no two people are the same. I've had clients taken a year to purchase. They've done 5 inspections and walked away from 5 homes, you know, because you can't see what's in that house until you pay for it. And unfortunately, that's a learning curve, but well worth the money. So they didn't make an incorrect purchase. And in the long run, you end up with what you wanted to get at the end. So those things are all important, and it varies a little bit. So it's not just everything's easy. You know, if you happen to find a home that's in great shape and everything goes boom, boom, fantastic. You know, I just worked on one recently where there were some conditions that almost jeopardized the transaction, but the seller said, I'll make this right. They did, and kept it going.
Wow. Okay, so after signing your disclosures, I guess this kind of goes into the same part, but you're going to sign all your different loan disclosures as you get through the transaction. Your appraisal is back. Everything looks all good. You're going to actually go to the closing table. So we kind of touched on this already. This is where that escrow agent is going to sign you through all your final loan paperwork, and everything is done. And then you'll get your keys that day, usually in the afternoon. The transaction should record with the county by like 4 p.m., 4:30.
Depends. Sometimes you sign the day before it records.
Right.
Yeah.
And then that's when you can get your keys. So that's the easy part. You go through all these details, all this back and forth with documentation, get your interest rate lock, get your appraisal order, do your inspection, not necessarily in that order. Then you finally get to closing, sign through, and you're done. You get your keys.
That's where you bring the big check.
That's right.
Yeah.
Yep. So you'll make an earnest money deposit up front. You'll pay for a credit report and an appraisal. But your down payment, all your cash to close, closing cost prepaids is going to happen actually on your closing date at the end of the transaction.
And that will usually come in the form of a cashier's check, certified check, or a wire, because that has to be official documentation, not a personal check.
And so we're going to verify that money up front, but you don't have to spend it until the end of the transaction. I have had transactions where the person does not have the money to close until like a day or two before closing, and then we verify it, get everything wrapped up, and then close last minute. Obviously, that's not ideal. You want to have additional money in the bank. In that scenario, it worked out fine. They're high earners, and they had to buy kind of impromptu situation. But, you know, those are things to be aware of. Okay, so after you get all closed, you get your keys. You're going to get, there should be in your closing paperwork, you also get this in the mail, but some information on how to set up your first payment. Your first payment you might have to make manually or over the phone. Your subsequent payments you can usually set up for automatic payment. But that's something that you're going to want to watch for because it's not just automatically set up. You have to go and set that up. That would be kind of your last step of actually getting your loan in place. And then you either make your payment every month or you set it up for auto pay. And then that's pretty much that. You now have a monthly mortgage payment and you're living in your house. And Bill, are you able to call your loan officer after closing?
Absolutely.
Okay.
Because even if, you know, the loan's done, it's sold, it's gone, a lot of times some new servicer could buy your mortgage too and transfer ownership. And so that's usually when we get a phone call. Hey, by the way, I just heard this, you know, and Mr. Cooper is my new lender, and they think it's a joke. It's legit. They're one of the largest servicers in the country. But everybody got nervous about that. And so a lot of companies, large servicing companies, buy the servicing after the fact of where you make your payments. It doesn't change the terms of your loan. They stay absolutely the same. But it's just where you make your payments. So things do happen after the fact. You can definitely call your loan officer and confirm with.
And I would say that's probably part of the more modern mortgage is that they're getting bought and sold on the secondary market behind the scenes. The historic mortgage, you know, Capital Bank would do your loan and they would hold on to that mortgage. And you make your payments to Capital Bank forever. Well, Capital Bank figured out there might be more money in it if they can do your mortgage and then sell your mortgage to another investor. So that's kind of the modern landscape of secondary market and how some of these financing tools are bought and sold amongst investors. So that's a different story.
It's a whole nother conversation because Fannie and Freddie actually own the mortgages, but the servicing is handled by somebody else. So that can get confusing. So bottom line is you want to know, where do I make my payment and when?
And the other bottom line is that this is actually better for the consumer, even though it's more annoying, because you're going to get better terms on market rates. But your loan might get sold, even though none of your terms can change. You might be making that payment to somebody else, which can be, it feels a little weird.
Yeah, there's a new thing now. It tracks every loan. This is since 2008 after the meltdown, called a MERS writer. And so they track where that loan is transferred to. So there's no mystery anymore. Back before this happened, loans got sold and they didn't track it. And it was kind of a mess. So they've corrected that scenario so these things don't happen. And if your file gets transferred, you also have a 60-day window. So if you make the payment to the other lender and it comes back and you got to send it to this other lender, it's not a late charge. Those things get adjusted. You have a grace period when these things happen too. Again, something to talk to your lender about so you're aware of these things, because you don't really have that discussion before you close on a house. It comes up after the fact,
Right?
And everybody gets nervous.
So those are our 10 bullet points of kind of going through the loan process from credit application to appraisal to documentation, signing, escrow, and then making your first payment. So hopefully that's a helpful overview. If you have any questions on how to calculate your type of income, what type of debts we're counting in our monthly calculations, like there's child support and all these other different types of debt that can be either included or not included depending on how they're written into certain agreements, whether it's on your credit report or not. Maybe you have judgments, maybe there's a bankruptcy in your past. All these different things mean different things. And so it's a little checklist and a little flow chart that we have to follow and ask all these questions to figure out where you fit. So if you think you have any specific questions for us based on this overview, we're happy to dive into that in further detail.
Yeah, and there's different documentation that go with those things like bankruptcies and divorce decrees and child support documentation, receipt of child support, all those things. Everybody's got an individual situation.
But that's why we're making this overview, because there's so much that goes into this process. You might not need to know every piece of it. Maybe some of these, lists of 10 jump out to you like, oh, I really want to know more about escrow. That's confusing. I understand everything else. Well, then let's just talk about escrow for 30 minutes and then hopefully you'll feel better and, be good about your loan.
And the other key ingredient, go back to documentation. Let's go back to pay stubs. This is one thing I'd say 50% of the people do incorrectly. They say, what's your income? They put down what they receive in their deposit. We get to use the gross income off your pay stub. You never get to see that number, but we get to that's what we get to use to qualify. So, and if you just recently got a pay raise and you're salaried, we get to use that number immediately. So all these things come into play. So everything has adjustments or details. So sometimes you think your lender's asking you a lot of questions. It's because they want to get you the best situation. And and things can come up after the fact that we can adjust for. But if you just got a raise, or one's coming, all that stuff can come into play, and it could make a difference in qualification.
Yep. Okay, well, we'll wrap this video up for now, and we've got much more on the way. But if you guys have any questions, want to schedule a virtual Zoom call, Google Meet, or just regular phone call, we're pretty available for that anytime.
Yeah, we'd love to answer them for you, help you take the right steps as you move forward, and we'd love to be your lender.
All right, have a great day. Take care.